Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Elliot Kallen of Prosperity Financial Group. You're the founder. Where is Prosperity Financial Group, by the way?
We're in the East Bay of the San Francisco market.
Okay, so up in Northern California, I guess.
San Ramon.
Right on. So you've got some contrarian views here on the market, on stocks. And the one that you started with, which I think is a very interesting one, is that we are going to have a recession, but it's going to be a mild recession, right?
Correct.
So tell me about that.
Well, Nathan, it's great to be on your show.
Yeah, thanks for coming on.
Can I call you Nathan instead of Nathaniel?
Of course. Yeah, of course.
Yeah, it's great to be on your show. When you're talking about the definition of contrarian, it means you're going the opposite way of the masses. And that's in life, that can be a very good place to be, the opposite place of the masses, because it makes you stand out. Kind of like the road less taken in poetry.
Yes. These are all reasons for me starting the podcast, but go on.
They're great. And it says something about your personality that you don't want to blend in. And I too, running a financial services firm as we do, and I've been running it now for 30 years. It's a long time now. We've always taken a contrarian point of view. Nice. It doesn't always work. I can tell you, it's not 100% foolproof for sure. Because if last year, 2022, you took the contrarian point of view, you would have bought technology and you would have been down no less than 40%, and in some cases 50%. For the year, and probably had a whole bunch of clients walk out your front door or back door and been very unhappy. And if you held that till today, they would have said, wow, you were a genius, because the masses said, sell technology and don't buy it for 2, 3, 5 years to come. There's just no money in it right now. Everything's overpriced. Still, the PE ratios are still, stupid with some companies. Certainly don't buy Apple. Look what happened to Apple in the last week or two. Right. So contrarian says, okay, who's making money? Who are the leaders? Who are the followers? And how can I be part of the leadership team? And that's what we try to do here. So in hockey terms, in Wayne Gretzky terms, it's where is the puck going? But Morningstar and the news, and it doesn't matter whether you're Fox Business or MSNBC or CNBC, it doesn't really matter. Everybody's got, for the most part, a rear view mirror of investing. This is what worked yesterday. This is what definitely will work today. And they're almost always wrong because they work in cycles. Same thing with real estate, although real estate has proven almost every contrarian to be wrong. So we are very slowly buying back into technology right now, because we think that they will come out of it, but slowly, because we know that it's somewhere in the middle of the recession here, which we think will be the summer or late or early fall. We know that when you come out of it, though the American technology in particular will be the leader, you want to own it before it goes up by 10%. So somewhere we're buying in little by little by little as a contrarian point of view, versus most the mainstay will say, get out of anything that's growth oriented.
Yeah. Where are the buying opportunities for technology though? Because as you mentioned, this year has been, it's a new bull market for the NASDAQ and for tech stocks.
It's very interesting on that. I think technology is going to pull back in the next 60 days. That's your good buying opportunity. I think Apple's always a good buy, but I'm a much bigger fan of ETFs than I am of individual stocks. I think when you're buying semiconductors, which have been beaten up this year, and I would not buy them right now, but rather than buying Intel, I'd rather buy the ETF. Although AMD's had a good year, Intel is not. So I'd like, there are all types of computer chip, computer software buyers in different ETFs. I don't want to do an ad for them, of whether you're like Power Shares, iShares, or Pro Shares. I don't want to do that. But you should be looking at that. And that's what we do for our clients, is where's the puck going?
Yeah.
And let me throw into that as well, in the technology world, cybersecurity, because we're just waiting for one big national cyber attack. And that, not that I wish that to happen, but that will just drive that sector straight up through the roof.
Yeah. And there too, probably ETF for index investing.
Yeah, I do.
Interesting.
I do like ETFs rather than individual stocks. Could you make more money buying Apple than buying, phone or software ETFs? Yes, you can. That's the beauty of having it. But you can also get it blown up like by owning PayPal and be off by 65%.
Yep. Yeah. And especially when it comes to cybersecurity stocks, some of those are very small companies and very volatile. But if you do the sector through an ETF, it's probably a better way to get the exposure. So, okay. So you're cautiously starting to buy tech ahead of what you're expecting is going to be a recession. Obviously, it's impossible for anybody to time these things perfectly. But how do you see this playing out now this summer as the economy, I guess, starts to roll over? Or what's your view there?
I think we're just beginning with what I call a flat line, which is a trading range. And it's a pretty flat trading range. I think we're going to be there for some time to come now. I think the money that's been made in the market's been made till the recession. We own a lot of value, even in our growth portfolio. We own a lot of value products in there with some growth sprinkled in there versus 2.5 years ago, I owned zero value. It's really a big difference in there. But so everything we have now, Nathan, pays dividends.
Right.
Now, if you bought small cap value because you wanted to be ahead of the curve, then your number one holding sector inside there was regional banks.
Yeah.
And we didn't do that.
Okay.
I have a problem just with the marketability of small cap value. I like mid cap value. And the reason I like mid cap value so much, solid companies, most of them are not over leveraged. And the large companies come in and buy them out in the middle of a recession. They become very saleable at that point. And I want to be there when they're being bought out. Okay.
That's not something that I've heard being talked about much, actually. This idea that mid cap value can be recession proof. I would think that a lot of the small caps, mid caps would all be cyclical, but that's not the case.
Everything's cyclical at the end of the day.
Sure. Yeah, sure.
But I do like, if you're going to play contrarian, then who are the companies that have good cash flow, good market niches, and would love to be bought out? And then you're looking at basically, instead of looking at market cap of 10 billion, or some of these market cap numbers are so ridiculous.
Yeah.
You can have zero profits and have a $50 billion market cap. It's just, look at Peloton at the height of their market cap. It was just ridiculous. They were like $30 billion or some stupid number. But so I look at, instead of looking at market cap, I look at sales and PE. And if I see a company with pretty good sales and growing sales, but struggling at the bottom line, that's a takeover candidate.
Okay. Obviously, you wouldn't want to have too much debt on the balance sheet either.
No, and I do stay away from companies that heavily invest on bank loans and bank loan portfolios, credit loans, credit. These are hard. I don't mind some private credit, but the public credit problem is that when interest rates go up, these companies, even a company like ours, their interest rate that they're borrowing at goes from 4 or 5 to 11 or 12. And if your margins are thin and you're in growth mode, man, that's just sucking away cash every minute of the day.
Yep. Yeah. You mentioned interest rates, and you talked at the top how you also have some, well, I don't know if I was about to call them contrarian, but who knows what qualifies as a contrarian take on interest rates anymore but what is your take there? Because we've been going up and up and up here, and the last Fed meeting, they raised a 1/4 point. Now, who knows what's going to happen in the next one?
I would say we're in for one more 1/4 point hike at least. And then that's the top of the curve right there. So when I'm buying, we've owned all year treasury bills, not treasury bonds, treasury bills. We've owned anything that's 2 years or under in the bond market. We think that, and those are paying between 4 and 5%. That's fantastic for a lot of clients. If you're owning treasury bills, which is, kind of a no-brainer, they're state tax free. If you're living in a state that's taxable, which is great. But again, this summer, by the time July, August comes around, and or September, we hit the bottom of that curve. You'll never know when you're at the bottom. you want to move the spread out. And I know we get all technical jargon on spread and curve and short end of the curve and long end of the curve. But if you think about things that are due in 3 to 5 years, bonds that are due in 3 to 5 years, corporate bonds, then those bonds are considered the medium part of the curve.
Right.
And those are highly beaten up right now, highly beaten up. And that's where I want to buy that in, because as the Federal Reserve begins to flatten or lower interest rates to help stimulate the economy back as we go into also a presidential year, then that's the part that will do the best. If you own the long end of the curve, they'll do really well when interest rates go down. But you are so far out there, it's so dangerously exposed if we get another bad inflation report.
Yeah, but the short end of the curve is also pretty much a victim of certainly of the Fed rates, isn't it?
Everything is again, but yes, but we're on our short end of the curve. It's paying between 4 or 5.25%, because it's 6 months or less. It's 12 months or less.
Yeah.
That's what I'm talking about short.
Okay, so that's really short, yeah. But it also sounds like you're collecting that for the yield as opposed to as a capital gains.
Yeah, but I have it in IRAs as well.
Uh-huh.
Look, I can tell you for my clients, none of them like getting a 1099 with income on it.
Yeah.
Nobody. I don't care how well they tell you, like, well, I want to preserve my principal. I want to maintain strength. And then they come up and say, well, I didn't know I owe so much in taxes. And they made, $51,000 in dividends or $21,000 in dividends. And it's all short term, and they've got nothing to offset it because everything that's offsetting it is long term. They get upset with us.
Yeah. Okay. So it sounds like you're expecting this summer, the economy to kind of roll over this summer and the Fed to have to cut rates sooner rather than later.
Late summer, early fall, the latest. I think we're done. I think the travel's out of our business. The fuel's going to be still about where it is today.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
As consumers, we're starting to run out of capital in this country. We're still spending it. We still have a little jet lag from COVID, but that's all going to be behind us very shortly. And then you're going to see people pull up their belts and spend less money. One of the ways I judge this is by the amount of traffic at Costco.
Okay.
And that is down significantly.
It is.
And that tells me, versus during COVID, it was up dramatically. It tells me people are buying less.
I didn't know that traffic ever went down at Costco.
I know, it's hard to imagine that, isn't it?
Yeah.
Go there now at 5 o'clock and look at how short the lines are at 5 o'clock.
What do you have to use that? I mean, is it other than what they report in their quarterlies, I guess?
Yeah, that's a visual for me. I go to several Costco's and check them out. Not just because I buy at Costco, but because I do. That's one of my places. I look at lines at McDonald's. I look at lines at traffic cashier lines at Costco. Those are two places that I look to see what it's like. I look at how many high-end restaurants are closing their doors. I went to a really nice restaurant last night in San Francisco, and I know Monday night's an off night. We were the only table there.
Yeah.
That says something.
How much of that do you think is a regional economy thing, though? Because we've heard everywhere about how San Francisco is basically entered the dark ages and how everybody's leaving San Francisco, et cetera, crime and what have you.
Well, you're right about that. San Francisco, New York, Chicago, these are cities that just at this moment do not get it. They're not getting it. So in those cities, there's going to be a problem. Boston gets it. Nashville gets it. But in Florida, you have many pockets now where real estate has more than doubled in the last 3 years, and it's backed off by 15 to 20% this year so far. So there is some backup going on. Lots of parts of California now are backing up. Not every part. My street in Lafayette, California, because there's so few homes for sale, there's no prices going down. There's just no inventory. But other places that have inventory are seeing prices coming down again. That's less money for the consumer.
Yeah, but you don't think that's just a regional a thing in your local economy? You think that there's enough of that?
All buying, all real estate is always regional, no matter who you are. There are always pockets like Nashville or Austin that are booming today, no matter what, because the pockets that are suffering are moving to the pockets that are thriving.
So tell me about the lines of McDonald's. Is that a contrarian indicator, or is that like a leading indicator? Like, is that good for the economy or bad? Like, if
Well, you would think when times get tough, the lines at McDonald's get really long because people still want to eat. But
Right.
now, and typically McDonald's thrives during bad times.
right,
But they just did a layoff at corporate headquarters.
right,
And so they see some things happening out there that are not good for them.
uh-huh.
And they just changed the taste of their hamburger around. Now, the part of that could be that there's more competition than ever. I mean, you can't watch any major show without seeing an ad for Wendy's or Carl Jr.'s or Burger King or McDonald's.
Chick-fil-A, yeah,
Chick-fil-A, they brought back McBurglar. They're doing things to try to get back on top. And they've been the lead dog for a very long time. But the lines in so many places have gone down. Our office is right across from In-N-Out Burger. In-N-Out Burger here in California, for people that around the country, that is a staple of fast food unique to California. Unlike where I grew up, White Castle was the best hamburger around.
Mhm.
And East
Are you
Coast.
from Queens or Brooklyn or
I'm
Long
from
Island?
Jersey.
Oh, okay. I didn't realize they had White Castle there too. Okay.
Yeah. So out here in California, I could see out my window to In-N-Out. The lines are down at night, and they're long lines. They're down by
Yeah.
30% if you count the number of cars.
Interesting.
so
That
that's-
is really interesting. Okay.
And now people in my office have started to bring their lunch. 'Cause they
Oh,
said, gosh, it's becoming so expensive. I can't go out anymore.
huh.
And we're a building that's 50,000 square feet, and more people bring their lunch. That says something right there again.
Interesting. Wow. I wonder about also like Chick-fil-A lines. Like, if you guys, I don't know if you have them out there, but here on the East Coast, wherever you see these, I mean, the lines are like, the cars are like backed out like around the block.
Well, that might be because they're stealing business from McDonald's or
Yeah, that's true.
other places. I know Burger King out here in California, and again, we're regional. Burger King lines are down as well.
Yeah.
So
Mhm.
there's something going on there. Some shifts going on. I mean, there are shifts going on every day. I just heard today, was it today that Wendy's announced that they will start using AI
Hmm.
in the late night drive-through line to figure out what they need to have made to make the line speed up.
Wow. Okay.
They expect that to decrease the number of people they need by a third at night.
Yeah.
I
It
believe
seems
was-
like AI is one of these things now where people sneak language of it out in their press releases, and it gives their stocks a boost, kind of like cryptos in 2017 or 2018 or what have you. Okay, wow. So that's all a bunch of really interesting stuff. But you don't think that the recession, when it hits, is going to be particularly bad?
No, I know there are plenty of people who see a deep recession. There are big warning signs out there of things, red flags. Let's call them red flags out there. The $31 trillion of debt is a red flag in this country. The $267,000 of average debt per taxpayer on a federal debt is just an alarming number. It's so big it can never be paid back. We've crossed the line of ever paying it back. So now who's going to buy U.S. Treasuries, and how much do we have to get them out in the marketplace for? And when the U.S. government does that, they crowd out other debt, and so that's a red flag out there. But I'm still going with that. The majority of people, because they're hearing every day about the recession, every day, 24-hour news cycle. You're doing what you're doing. I'm doing what I'm doing. 5 years ago, who heard of a podcast?
Yeah.
And so since we're hearing of it, we're kind of bracing for it. We're more aware of it. And therefore, I think just as consumers, we're willing to say, okay, how long is this going to last? And let's get out of it quickly.
Okay.
We're not going to be the victims that we've been in the past.
Okay, that's interesting. But I always thought that in the age of social media, we haven't had a social media recession yet, except for unless you include COVID, which is like a month. But and I say this is based on as having lived through the 2008 disaster, and even from before that in the early 90s. From what I recall, it seems that every single recession is the worst one since the Great Depression, and it's always like it doesn't seem there's really a mild recession when you're going through it. But that's something that's applied retroactively. That's kind of my theory. But I
don't subscribe to that, and I'll tell you why. We just had and we're really still in a regional banking crisis. 3 banks disappeared in the last month. Okay. And it's all over it's everywhere. Everybody in America knows about this. We live in California, Republic Bank, Silicon Valley Bank out here. everybody knew about it. So what did the consumer do with 24-hour news? They moved their money out of Republic Bank and moved it to Chase and B of A. So the bank's too big to fail. What happened in 2008? Everybody was a victim and did nothing because there was no internet telling everybody what was going on. We were hoping, kind of crossing our fingers, that this would not fall apart. So the consumer is reacting very quickly and saying, where can I be safe? Where can I be smart? And so that's not just going to happen on banks, that's going to happen on every business. So McDonald's announces tomorrow, I'm sorry, we're going to recall 25 million hamburgers because of E. coli. The next day, the lines at Burger King and In-N-Out and Chick-fil-A are out through the roof, and nobody's at McDonald's. And when there's no internet telling them that, they don't really know what's going on. So we're nimble now, very nimble and much smarter.
Yeah. And to your point, everybody has brokerage accounts now, which, by the way, are free, which they were not in 2008. It was like $20 a trade or something ridiculous back then.
Also, you're expecting, you are more accepting the fact that if your account goes down by 10%, you're not going to go out of your mind and withdraw. In 2008, the second that started to go down, people were just freaking out, didn't know what to do. And in 30 seconds, it went down by 30 and 40%.
Yeah.
Before people could react. And we're much more nimble and we're much smarter about it today.
Very interesting. All right. Elliot Kallen, this is some very interesting insights onto the economy, onto stocks. And I want to come back and ask you some more stuff about yourself, about your firm, about your views on the markets. But let's first take a quick break. If you are a premium subscriber, don't go anywhere. Don't touch the dial. You will not get the break. We'll be right back. In fact, we already are. And everybody else, to become a premium subscriber, visit the website contrarianpod.substack.com and sign up.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack that where you can sign up for the same prices, same benefits, same details, contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com, whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show. Welcome back, everybody. Here with Elliot Kallen, founder of Prosperity Financial Group. Elliot, this is the segment of the show where we ask our guests to tell us a little bit more about themselves and how they got into this station in life. I mentioned that you're the founder of this firm, so curious what you did before, how long the firm's been around, and I guess, how you got into investing in the first place to kind of put it all into Marvel terms here with an origin story. So take it away. Tell us.
Thank you, Nathan. I've been doing this now for 30 years. The firm is 27 years old. I've been doing this for 30 years. And I consider myself much more of an entrepreneur than a financial advisor, because this is not the first company I've started. I started a packaging company environmental cleanup after that, worked doing some mathematics, and then came to California in 1993, joined a financial advisory firm, and then started our own firm shortly thereafter. And today we have two firms here. Each one is pushing $400 million in total assets out of the same office. And then we have a charity that we run as well. So we have been working with B2B and clients on a regular basis for my entire career, and then transitioned to include B2C. Here, 40% of our clients are entrepreneurs and own companies or did own companies. They're the referrals of people that have owned companies. We speak their language. We understand how you can have receivable problems, payable problems, employee problems, HR problems. We've been there, done that. And so we have that language. And then we've all experienced here the problem of not planning properly with your estate, with taxes, with kids that have fought over money, with losing family over money and divisiveness that comes around. So there's a lot of real life experience that has gone into our firm. And we have 5 advisors plus myself. We work with them. I work with the higher net worth group on that. I build my own portfolios. So we are direct builders of portfolios. I spend 70% of my time doing this, interacting, and 30% of my time, a little bit of an economic wonk, building models, talking to PM, money managers, reading economic reports. I get over 100 a day. You can't even begin to read them.
Yeah.
But you get over 100 a day. Some of them very much contrarian with each other.
Yes. I know that from reading some of these, and in some cases writing and editing them myself. Yes.
And if you listen to CNBC, the morning, afternoon, these people can be 100% polarized with each other.
Right. And there are certain individuals that will remain nameless, Jim Cramer, that are very good contrarian indicators as well. But that's another topic for another day. Yeah, wow, very interesting. So I'm wondering here, as a fiduciary, and you have, you're responsible for, like you said, these individuals and family and business wealth. How does one go about balancing life, and how do you shut off, or do you shut off? And the risk and the responsibility that comes with that. How do you go about managing that?
So Nathan, we have a saying here that says, if it's money, it's personal. We own that. We trademark that saying. So there are some advisors that leave their business at work. They leave their clients at work. They don't want to be bothered. We're not that. I'm the opposite of that. And that's a double-edged sword, because that means clients can call me 7 days a week. And some do, especially if they're worried and can't sleep. I've gotten those 4 a.m. calls.
Yeah.
And we work our way through that. I don't want to say we're boutique, because that means in a recent survey that meant small rather than giving great service. But we're definitely a white glove organization, and we give really great service. So the idea is, when a client is making money, we want to share in the joy with them, not just the billing joy, but we want to share with them. We want to make those calls. We want to talk to them. We want to let them know things are going well and what we're doing to fix that and improve that. But when COVID hit, especially when the majority of people in my industry put their head in the sand and acted like a bunch of ostriches and stopped going to the office, and the big brokerage houses, they completely shut down. And even to this day, they're half empty, a lot of them. We were the exact opposite. We went aggressive. We put an entire marketing department together at the beginning of COVID. We started to reach out to our clients. We sent out bi-weekly emails of what we're doing, and we began to buy. We began to clean up portfolios and buy. So when everything dropped dramatically, and we thought the end of the world was coming because we had the next Spanish flu of 1918, we were buying. And we were buying heavily into biotech and tech in 2020. And of course, we went up by 60% that year. For the most part. It was a great time to be in that. So we take this personally, and I could tell you in 2020, we stayed up every night. Today, we're up a lot during the night at 2 in the morning or 3 in the morning. My wife looks at me like, really, you just can't sleep? I said, I can't sleep. Said, no, it hurts me to have any client not making money and not reaching their financial goals. It's painful.
How quick are you to sell out of positions that once they go against you? Do you have strict stop loss limits?
We do. We have here's how we work it. We look at a strategic, how we want it to look strategically. So the portfolio is set up to look a certain way strategically, 4% here, 3% there, 7% there. But tactically is where we really excel, because we put what we feel are the best products from the best vendors inside these portfolios, and we are merciless to them. We tell them, look, we may kick you out in 30 days, 120 days. In 9, we might kick you out because you're not doing what you told us you were going to do. Now, if the market's down and they're down with it, we're not kicking anybody out.
Sure.
But if the market's up and they're not tracking or they're not beating what they said they would do, they're not going to make it till the end of the quarter. We will be merciless. Our clients have asked us to be merciless. That, look, we trust you. We know that you're looking at it every day of the week. And so just because I'm taking you out of the portfolio in May, doesn't mean you're out of the portfolio forever. I may put you back in August, but I need you to go down further because I see it coming.
So it sounds like you have an actively managed component there. I mean, and I'm not talking about what you're doing, but who you're investing in. Are those actively managed mutual funds or?
Yes, we don't do anything passive. The only thing we do, if you want to call it passive, is we do sector bets.
Right.
Using ETFs.
Yeah.
And one could call that passive investing. But even then you could get into the alpha side of those passive, and they become much more aggressive and much more active.
Oh, that's interesting. Okay. So because we've heard a lot of debate, of course, about the whole passive versus active thing and active management being dead and blah, blah, blah. It doesn't sound like you quite subscribe to that, I would assume.
No, I am a big fan of active management. I think, look, Vanguard has done an amazing job educating and advertising to the public that cost is everything. They've done a great job with that. And they've got a loyal base because of that. Okay. But they never say what I think is more important, that your total return after cost is really what is most important to the client. That's what everybody asks me when I sit down with them. How am I doing? They don't say how much does it cost to do what I'm doing. That's not their first question. We will talk about that, but they want to know how they're doing. And so in stretching terms, if I make my client 20% this year, okay, every one of them is going to be really happy, right? But if I really made them 30, but to charge them a 10% fee to do that, will they still all be happy making 20%?
I would think so.
Right, because if you're looking at the 20%, and let's assume that beat the market and we killed it, they should be thrilled. Yeah. But Vanguard's got them thinking, no, that fee that advisor took is more important than your total return. And they've got it backwards. The client, we don't pay bills based on top line numbers. We pay bills on what we take home. You show your returns and your success based on the net after everything. And now if your net is not good, then your fees may be too high and you're compounding the problem. Right. But if you're within reason and you're outdoing what you said you would do, I don't mean to outdoing the index, because to just beat the S&P 500, your portfolio may not be geared up to do that. But to outbeat whatever you compared as an index and not get paid on it, then you're not a good business person either. Yeah,
yeah. And, that's the argument that hedge fund managers certainly use, and some with reason. I mean, if you invest in a Renaissance hedge fund that did crazy returns, and you'll gladly give them 3% and 35 off the top or whatever it was that they charge, because the returns are consistently so far ahead of the market that it doesn't matter. So do you find it, but it must be a challenge to find these active managers, and do you have any, without getting too much into it, what kind of criteria do you use to determine who's a good active manager?
We meet with almost every active manager, whether it be Zoom or in person. We don't just take them on. Nowadays with Zoom, that's the best thing about COVID is the Zoom world. Even though if you invested in Zoom in 2021, you've not been happy at the end of 2022. Right. So we talk to them, we look at them, we want to understand them. What is I don't want to say alpha, because now I'm into industry jargon. What is the exceptional advantage that they bring to the table that the index doesn't provide? And for many of them, it's actively getting rid of the dogs. Indexes always include dogs. They just have to by definition. And so that's good. So if I can have an S&P 275 that crushes the S&P 500, I'll take that all day long. And that's just one example of it. If they say, hey, Elliot, I'm putting this together, I think it has a real bent towards actively run, well-run technology companies. that are leaders in their field across the board, well, that's a positive active manager. Yeah, that's what I want from my active managers. I want them saying they're good. This is why I'm in it, and this is what I bring as above and beyond the normal return. You're paying 30 or 40 basis points additional to have that happen.
So how much of the typical portfolios are in active management versus ETFs versus individual stocks versus bonds? Like, how do you usually structure these things?
I would look 80% of everything or 80 to 90% of everything I do is active.
Right.
It's right up there. Yeah. And I'm active.
Meaning you allocate to active managers, or you do active investing, or both?
Both.
Yeah.
I use active managers. It's kind of like a double activity thing.
Yeah.
I want active managers that do what they say they're going to do, or explain to me why they didn't. I want to be very active with them and very on top of my game in a strategic world, right? But we can't take the old mutual fund concept of just buy and hold. That doesn't work. That's like the 60-40 portfolio. It doesn't work anymore. It's been out of fashion for a long time. Buy and hold doesn't really work. Could you have bought ICA from American funds in 1940 and held it today and be worth millions? Yes, absolutely, that's true. Or no question about that. But today is a different time, and you've got to think about what's in that and where the puck is going. Where's the market going? Because it is changing by the day. Now, on that note, there, Nathan, is you don't want to also be subject to the whims of the headline that says what came out in 2000, where revenues are everything and profits are meaningless. The new economy is good and the old economy is dead. That was the headline of 2000. That was completely incorrect. So if you don't want to be just a headline follower, you want to dig underneath it. And that really pertains to your whole concept of a contrarian, that what are they saying? And I'll do the opposite.
Yeah, that's exactly right. Yeah. So I'm curious, you're out there in Northern California, which has been, of course, the kind of center of all things tech for 40 years. And do you have any views into what you think might be the next big growth? Maybe not companies, but industries. Do you have any thoughts on that, or is that outside of what you do? Is that not something?
No, I love what you're saying on that. I think if I were to pick one sector that is going to be above and beyond, it'd be healthcare or biotech.
Okay.
Those two. The biotech companies get started and get sold.
Yeah.
That's the nature of biotech. So when you're buying biotech, you want to buy small and medium-sized companies. They're going to be sold. That's your winner. Right? When you're buying healthcare, you want to buy large companies that pay dividends because they've got a lot of cash on the books. So those two, as we're aging, and I don't see any gray hair on your head.
No, but I don't have any hair either. So
yeah, but you do see some gray on my face and head. And so that healthcare cost is going to go higher and higher. My doctor that I've had now for, I would say, for 5 years, who I really like, announced that he and his wife, when they practice together, are going to become concierge doctors and by subscription. And it's $250 a month for my wife and $250 a month for myself. Still with Blue Shield though. But now I have to pay to go see them, a subscription price. You're going to see more and more of those type of things out there because it's harder to get a primary care physician. They're being handcuffed by everything, by the cost of doing business around there. You're being diagnosed earlier with diseases that are now curable, but super expensive. The cure is millions of dollars. Kaiser's already made a decision years ago. Most of those high-end cures, they're not going to bring in-house. They're not. They may send you to Stanford, but there's a good chance that you're just not going to get it. I'm sorry. You're a statistic. You're a little bit old, and maybe your time is up. You and I don't accept that probably because we're the consumer, that some institution is going to tell us when our time is up. So we're going to want to spend that $1 million on a very rare drug that cures my very rare cancer. And that's, again, who's doing that? How's that going to work? So I like that a lot. I think cybersecurity, again, that's an ebb and flow, but once you have an attack, again, that's just going to take off. We get another type of Experian thing where 2/3 of American Social Security numbers get compromised. People are going to go crazy and you'll see that sector just blossom or a plane go down or something like that. We'll get that. I think those are really good. I think chip makers are really going to struggle for a while on that, although it's interesting to see that whether the United States decides to put up a ton of money to help manufacturers move out of China and either bring it back here or bring it to Vietnam. Somebody's going to be the beneficiary of leaving China, because China, people are beginning to realize just finally that China is our enemy, and China wants world domination, much like Japan did in the 20s and 30s, or Germany did. And they're going to go after it in a big way. And you can't even buy a simple antibiotic shot if that's not made in China today.
Yeah.
If we went to war with China, we've got a big time problem in our medical business.
Yeah.
And those are things that have to change.
Mm-hmm. Mm-hmm. Yeah, and that's something that both parties rarely get behind now. Really interesting. All right, Elliot Kallen of the Prosperity Financial Group, thank you so much for joining the Contrarian Investor podcast today. In closing, maybe you can tell our listeners how they can find out more about you, more about your firm. I imagine you have a website. I don't know if you're on social media, but yeah.
Well, we're everywhere on social media.
Oh, cool.
It's prosperityfinancialgroup.com.
Mm-hmm.
It's Elliot, ELLIOT, at prosperityfinancialgroup.com. We're on Facebook. We're on Instagram. We're on LinkedIn. You can catch me on LinkedIn. We're in Northern California. I kid around. I've got a face that's great for radio and a voice for TV. But you can catch us, and we'd love to talk to you. And like yourself there, Nathan, we have a number of podcasts that people are welcome to listen to. Subscribe. I'd love to subscribe to yours. And
yeah. Are they on the iTunes and stuff? What's the podcast called? Meet
the Expert with Elliot Kallen.
Okay.
And that's on all the major places that you get podcasts.
Mm-hmm. Cool. But you did not, you mentioned you're not on Twitter. Interestingly, have you never been?
No,
on
we're
there?
not. For a long time, Twitter was unacceptable in my industry. It was an issue. It is no longer that issue, because the issue was all about capturing the message. It had to be captured and archived somewhere, and Twitter was not geared up for that. But now we use Smarsh, and Smarsh now can handle that.
Right.
And so I'm not yet on Twitter.
Okay.
That's one thing I'm not on yet, but you could bet that'll change in 2023. I'm quite sure.
Very cool. All right. Well, we'll look for you there too. But for now, I'll put those links in the show notes so everybody can access them. Elliot, thank you so much for joining the podcast. Again, thanks for your time. I really appreciate it. Thank you all for listening, and we look forward to speaking to you again next time. See you then. Bye.
Thank you, Nathan.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.